Hey, good to be with you guys here. Tuesday webinar. We're talking those bean calls. Hey, as always, our goal here is to hopefully provide a little bit of education, some new marketing ideas, and maybe hopefully a little bit of entertainment here. So let's get into it. Looking at those 1240 November bean calls, a lot of this is made possible because we sold cash in January, and so we had the flexibility to do something here with the market breaking down. We looked at this thing. We said the market is a little bit extended to the downside. The U.S. was getting competitive on the world market. And there were some clear upside targets that we could sell into or rally into. And that's why we were liking these calls. So here's a quick look at that November bean chart. We've got that hammer candle, which came in down near about 1120. And then we got into these calls or sent out a message about these calls on June 1, June 2. And the thing about that hammer candle is at least you know where you're wrong, right? I mean, you get a stop down below there. If the market pushes through, obviously, you're in the wrong area. So good risk to reward. And then as you can see, that 50-day SMA and 1240, that pink line up there, we were pretty far extended from that, and it was a reasonable target to get back to. So three trading plans. As you go through this, you can trade the premium, you could sell cash into rallies, or of course you could do nothing. What does it look like if you were doing trade the premium? Well, you get long these 1240 calls for about 35 cents. Now what you need to do is just flip your charts over to the November bean futures contract and look for kind of some resistance areas. So like 12 and a quarter, you start to pay attention. Okay, your premiums round up to about 53 cents, which is about a 15-cent gain and a about an 18-cent gain and about 50% return on your money. So maybe an area you could take one off. The other area, 1240, obviously that would be your strike price as well as where the 50 days at, and 1250 being a round number psychologically. Here, your premium's at about 70. Now, to me, this is definitely a no-brainer area to take some off. You've doubled your money. You can get your money out of this position. You made a 100% return. And then again, you just continue to scale out at targets. Use 1340. There's a 100-day moving average up there. Just kind of keep your targets like that and scale out. So it does pay to buy multiple options for that scenario. But ultimately, the bottom line, if you're going to trade the premium, is look at this in terms of a percentage. Okay, so if you got these 1240 calls, on June 2nd, okay, 7 trading days later, you're at the 1240 strike and you've got a 100% return on your money. I mean, where else in the country can you make a 100% return in 7 days? Okay, so that's the kind of things you have to think about in here. You got to remember, bulls make money, bears make money, and the pigs get slaughtered, and you do not want to be a pig in this environment. The other thing you could have done was use this to kind of sell cash into rallies. So again, you've got that same long 1240 for 35 cents. Maybe you're undersold on beans and you need some courage to make a sale. With the call running up in value, you can also make your sale at 1225, brings you to a 1240 net sale. You could also just sell and continue to hold the option. Or the other thing we like to do is if you're behind on corn, use this to sell some corn because you're not only sold cash on beans, but you're still long on the board. So you have a lot of flexibility to kind of make some decisions in here. And again, in our opinion, beans look like the better market to be long fundamentally when you look at the balance sheet compared to corn. And so again, you could make some new crop corn sales. Lastly, you could always do nothing. So you could either hold the calls until expiration or have a fluid plan or what do they call it? Cancel if close on these targets. But you generally this isn't the best idea. But again, it's a plan nonetheless. So let's wrap things up in here. Again, this whole process, okay, was because we made decisions early on in the year that allowed for flexibility later on. We did a webinar in January about buying December corn puts. And, another area where, making a decision at profitable levels and maybe even uncomfortable levels, considering the time period, allowed for much more flexibility as the year went on. You need to look at the total risk of your farm. So like we said, corn probably less likely to make a major run compared to beans when you look at the balance sheet. So it makes more sense to be long, long beans on the board than corn and maybe sell some corn into these rallies. And then finally, guys, have a plan or work with somebody who does. This stuff is not that complicated. Okay, we make it complicated or we choose to just ignore this stuff. We work with guys on doing this. Yes, we charge a commission for it. But I think it's well worth the value that you're getting when you can take the emotional side out of things and work with somebody who has a plan that can be followed through. So again, we hope you guys enjoyed the video. Make sure you hit the thumbs up button out there. We hope this made you a little bit better, and we look forward to talking to you again here soon.